That's all ahead, but first, let's take a quick look at the snapshot of the market because Bitcoin once again trading below that key 20,000 level for a second straight day. And of course, you see that pressure down about 2.7%, but put this in a volatility adjusted context. Historically, you need a drop of 4% or a gain, I should say, of 4% on an average day for that volatility to really make sense. So you can see in that perspective, in the historical context, Bitcoin's volatility a little bit muted in today's session. That isn't, of course, stopping it from having broader ripple effects across the stock market. Take a look at some of these crypto exposed stocks. Coinbase, of course, the crypto exchange, down to the tune of 1.6%. Even some of the names that are exposed to crypto in that they simply accept crypto as payment. Think Overstock, for example.
Welcome to another episode on the Wealth Supremacy channel, where we keep you abreast of the state of the economy, cryptocurrencies, and market analysis from top investment gurus. If you haven't subscribed, click the subscribe button now and smash the notification bell. We promise you top-class content only. Today, we'll be dissecting the latest interview of the CEO of Real Vision Investment Group, Raoul Pal. He'll be giving us his expert insights to what the indexes are saying and helping us make sense of it all. Let's go over to Raoul Pal.
So we're starting to see some of the regional Fed surveys falling apart, but what I'm really looking at is the ISM survey, the Institute of Supply Management. That's a survey of basically buyers in large corporations and industrial companies about how they see conditions. They tend to do a very good job of tracking the business cycle. GDP follows it. Now, there's this magic number, which is 47. 47 is the level at which it has a 100% chance of recession. Now, we're still in the 50s, low 50s, but all of the forward-looking stuff is going down to 47 for the shorter term stuff, i.e. the next couple of months, we should go 47 and maybe below, maybe 45. But the forward-looking stuff gets down as low as 35. So we're talking negative 2.5%, negative 3% GDP prints. And that would be, it should be bottoming by my work by about February, March next year. So the economy is about to go off a cliff. And I don't think the market is yet prepared for it. So let's go back to this Jackson Hole thing. What did they tell you? They didn't tell us anything new. They said, we really want to get to 4% and hold it there depending on the data. Well, the bond market, if I look at Eurodollars or Fed funds, they're already at 4%. So the market's priced that. So there's nothing new. So I think, okay, there's nothing new there. So if the economy starts getting weaker, because the Fed said they will be more data dependent, then we'll see the bond market starting to price in lower rates in the future. So I'm looking at that. And then the Fed said, well, they will change their mind if inflation comes down a lot and unemployment goes up. So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months.
The ISM is an assessment of economic activity in the manufacturing sector that is updated on a monthly basis. This survey measures the level of expansion or constriction in the economy based on productivity from local manufacturers. A reading above the 50 midpoint indicates the increased productivity, and any reading below 50 is an indication of economic constriction. The current US PMI stands at 52.8, which is just 2.8 points above us having a constrictive economy. The month-on-month index shows that there is a decline, and there is a consensus on it going even lower. Raoul Pal believes we could be seeing an ISM PMI reading of 47 or lower by February 2023. This would indicate an economy that is in full recession. At the peak of the 2008 recession, the ISM dropped to 36 points. By the time the government declared a recession in 2008, the economy had already slipped to record lows, forcing the government of Barack Obama to admit that the U.S. had actually been in recession since 2007. Interestingly, the ISM PMI composite index was at 49 at the end of 2007, when the government admitted the economy to be in recession, meaning we're just 3 points away from slipping into a similar economic recession of the 2008 magnitude. Do you think this can happen in the next few months? The U.S. manufacturing sector is not the only thing to slow down. We're actually beginning to see inflation dropping in correspondence with the drop in gas price. This is good news for consumers, but may not be good news for investors in the commodities market. Real believes within the next 18 months, we could be recording negative inflation in commodities.
So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months, which is something I've been talking about a while when I've been looking at, for example, the example of 1947, when people all came out of World War II, went back into the labor force, much like the pandemic. We had no supply because nobody was making everything because everybody was at war. We had this, prices went up 20%, 18 months later, negative 3%. Then it had a rebound effect and then balanced out. I think we've got something similar playing out now, which is contrary to the narrative that we've got sticky inflation. Everyone looks at the 1970s, that's what we're doing again. Unless the Fed crush it, they're Arthur Burns and we're going to ruin it. Well, in the 1970s, we had this massive demographic boom that kicked in just at the wrong point, which was the baby boomers entering the workforce. We have the opposite. We have in 2023, the record peak number of people hitting 65 in the US labor force. And that means peak retirees. So we've got peak retirees happening, and we've got demand destruction driven by this economic cycle. So the forward-looking inflation data to me looks like, if I look at commodities, I look at a bunch of things like new orders versus inventories in ISM, that they go negative. Okay, that's the extreme. That's actually my base case. Maybe I'm wrong, but inflation's coming down significantly and very fast. So the next part is the employment question. And again, when I look at forward-looking employment stuff, just the housing surveys alone, housing is the 5th largest employer in America. It looks like that they will start laying off workers pretty fast because they've got massive inventories. Everybody from Amazon to Walmart said we've got too much inventory. They're all laying off staff. Everybody's starting to lay off staff. All the tech companies are laying off staff. So I think we're going to start to see unemployment and inflation falling, the economy falling sharper than people expect. We're already seeing oil weak. We've seen all the commodities weak. Many of them are now negative year on year or close to it.
Big retailers such as Walmart are downsizing as consumers struggle with inflation. Walmart had even announced shareholders to expect a drop of up to 9% in profits this year. While the downsizing has not been huge, announcements of this nature are enough indicators that the economy is delicately balanced and could tip unfavorably at any moment. Though Raoul Pal focused on some retail companies downsizing, it should be noted that the U.S. employment rate has corresponded according to the stock markets or productivity as indicated by the PMI consensus index. We saw increased job openings in July, and the month of August has seen a rebound in consumer confidence. We're likely to see even more growth in employment as markets begin to pull out of the economic shock, which has been caused by high energy and commodities prices.
I usually say the bond market is the truth, but at turning points, it can often be wrong. And it tends to lag because this inflation narrative digs its heels in. And we've seen that in 2000 and 2000. We saw it in 1990. We saw it in 2008. We saw it in 2018. The bond market deviates from ISM. ISM starts falling, and then this Wile E. Coyote moment, and yields start collapsing. Now, why do I care about yields collapsing? Well, I've just told you that asset markets are actually pricing in a full recession. And I know there's a narrative out there that the markets need to price in a lower leg from earnings. But when I look at it in my terms using the business cycle, I think it's already priced lower earnings. So if bond yields start to fall, then financial conditions are easing. And the chances are the growthier end of the world, NASDAQ, crypto, growth technology plays will start outperforming. And we've seen many of those bottom a while ago when bond yields topped. Now, we need to see that play out. Tomorrow, day after tomorrow, is the ISM survey. I'm expecting it to be weaker than expected, but it could play out the following month. You know, economic data, 1 month to the next isn't a lot of data series or wiggle room. So let's see what happens. But the next couple of months, I'm expecting it to be signaling a full recession, and we'll get to the tipping point where bond yields start to fall. It'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in.
Raoul Pal thinks that bond yields are not realistic and too high in relation to the nation's productivity. We're seeing yields rising on short-term and long-term bonds despite the economic crunch. We're seeing bond yields reach highs they have not had in the past 10 years, with yields up as much as 2 points this year, driving the rate as high as 3.2% now for 30-year bonds. We saw the bond yields drop to 2.46% at the start of 2009 in response to the 2008 recession. We're seeing a lot of parallels in this year's economy with that of 2008. Likewise, we could actually see an economic rebound sooner than expected, based on these indexes. Do you think that the NASDAQ and SP indexes are predicting prices too low? Or do you think the Fed is rating the markets too high? In conclusion, Raoul Pal thinks market projections are wrong. He's sure that we have reached the bottom for asset prices, and cryptocurrencies would not go to any significant new lows than we have experienced already. Let's have your thoughts in the comments below. Remember to hit that like button and subscribe. We appreciate it every time you do that. See you in the next video.